Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we have Abhi Rajendran. How you doing today, Abhi?
I'm doing great. Thanks for having me, Kirk.
Good. Well, glad to have you on the show. I've been trying to find a guest who is just a real expert when it comes to energy, oil, and gas. There's so much going on in the world, and it's really hard to find experts that don't have a bone to pick and or take an extreme side. But wanted to bring you on because I know you're one of the foremost experts in the area. So maybe you can tell the listeners a little bit about your background to begin.
Sure. Yeah. Again, thanks for having me, Kirk. I work at a firm called Energy Intelligence, research and consulting firm, where I head up our research practice based on oil, downstream, North America focused energy, which is kind of across the board. I've also, I've been here about 5.5 years. I also work part-time at Columbia University's Center on Energy Global Policy. Center on Global Energy Policy, I should say. So I kind of chip in on various kind of policy and energy related matters at Columbia as well. And prior to my current gigs, I spent over 10 years on Wall Street, researching and investing and trading across the commodity complex. So oil, gas, LNG, kind of petchems, refining. Kind of bring a holistic view on what's going on in the energy space, and certainly spend a whole lot of time on on new energy and energy transition areas as well, because that's can't be escaped these days.
Yeah. So what got you interested in energy? Like, how'd you get started in it?
That's a great question. Interestingly, I actually started covering energy all the way at the other end of the value chain, covering the petrochemical space, which is kind of an interesting hodgepodge of different products that go into a whole host of different end uses and sectors. And I just kind of found it fascinating, how kind of closely tied to all different walks of the economy and consumption that energy products were. And then I, kind of slowly made my way further and further upstream. So I covered chemicals, then I covered, midstream, pipelines, infrastructure. Then I covered, upstream, and kind of, covered the whole gamut of it. So, yeah, between oil, gas, petchems and refined products, and also kind of new energy areas. There's definitely a lot going on, which is and then I kind of like to have kind of a macro view as well of what's going on in the world, and so how closely that's tied to energy was always something that fascinated me.
Nice. Well, I guess you could say energy kind of drives the world, so it's an important aspect to understand inside and out. So maybe you could kind of talk a little bit about, I mean, there's obviously a lot going on in the world. I mean, there has been for quite some time when it comes to energy, but um maybe you can kind of start by giving us kind of a little bit of an overlay of what you see going on in the world of energy and what are kind of the big trends that we need to be mindful of.
Sure. Yeah. I mean, I think, just kind of looking back before looking ahead. I mean, I think this past year, now that it's, pretty much winding down, really ripped, the conflict that started at the beginning of the year just kind of ripped off the band-aid of the supply issues, right? That we were facing on the oil side and the gas side, and really kind of brought them, or, really just kind of turbocharged them. And I think, back to, to the point that you were making, around how closely energy is tied to the economy. When things got so out of whack, the world felt it, especially Europe, right? Just kind of at the epicenter of all the issues that have been going on this year. The U.S. too, and other markets that are more sensitive to high energy prices, but more broadly high commodity prices, all felt it, right? And so the first half you had this huge big run up and the supply shock, and then the second half you've had kind of this fallout on the demand side. And I think this kind of tees up really what's ahead for the world, right? Which is one, on the demand side, a pretty complicated and messy picture. I certainly don't think we are headed for a global recession, but I think we're basically headed for Western either recession or stagflation, right? Depending on the region and how mild to severe things are going to be economically. But for Europe and North America, things are going to be quite soft for some period of time. And the flip side to that is how much can developing markets and emerging markets really kind of take the mantle of growth. There are certainly some bright spots like India. There are some other areas that are going to remain challenged because of high commodity prices, because of a strong dollar and other balance sheet issues. And then I think the big animal in the room is China, right? What happens to China, which we can talk about a little bit more, but what happens to their opening or not opening, coming out of zero COVID. So I think that's the first issue. The second issue is how does kind of supply balance itself against the demand picture, right? I think if demand is weak to poor, then I think you could argue there's going to be probably enough supply to manage through that, even if it's more just kind of just in time supply. But I think if you have any kind of a resurgence in demand, and even if you just have like seasonal pickups in demand, right, into driving season or into traveling season or into kind of economic up pickups, then you'll kind of see the tightness even more on the supply side, and that is going to be a theme that we expect for next year and probably even the next couple of years. And again, that's going to come back and bite demand. And then the third point I think is from a policy standpoint, right? I think you could argue that geopolitics and policy have played a role in some of these issues, both on the demand and supply side. But certainly there are going to be kind of ongoing factors in the energy sphere, but more broadly in the global economic picture next year. Whether you're talking about the Russia-Ukraine conflict, whether you're talking about energy policy, either trying to manage through the near term or trying to make some sort of an energy transition. All of these are going to be critical factors as well. So those are kind of the three things that are going to be kind of tugging at each other in my view: demand, mediocre; supply, restrained and underinvested in; and policy also a little bit jumbled, trying to balance those two.
So let's like, I guess maybe start with policy, because I think that's kind of a big macro theme here. I mean, we've had a big strong push for cleaner energy, green energy for a while, much to the detriment of I guess I call it dirty energy, right? You're talking about carbon, coal, oil and gas. What is kind of the policy, let's just kind of talk about what the policy directives are, or how does that kind of play in? Because it seems like it's really changed the energy industry with a policy that seems to be kind of counterintuitive.
Yeah, I mean, I would say the COVID downturn, right, was kind of used as this opportunity to really kind of push this narrative that in many respects demand was not going to recover and we're kind of going into a new paradigm. COVID has kind of changed the game, and so we don't need as much supply. We can kind of cut back on investment of old traditional dirty energy, or however you want to call it, and instead kind of turbocharge or accelerate the energy transition with more spending, more stimulus, etc. I think there've been a couple of issues with this, right? And there will continue to be issues looking ahead. The first is that that again, back to your point earlier, that the world economy is so closely tied to what happens in the energy sector. When you have disruptions and supply issues on the energy side, that takes a toll on the economy, right? And inflation has been very closely tied to energy / electricity / power, across kind of the complex, and then that's going to be kind of stubbornly high. It'll come down, then it'll go up, it'll come down, but generally we're talking about higher than we've seen in the past. And so these inflationary pressures have led to central banks being forced to tighten, kind of shift away from this era of low rates, free borrowing, free money, high liquidity, to an era that's going to be much more restrictive, much more tightened, much more difficult to to lend and to borrow. And that is also part of the reality. And so I think there are a couple of challenges, right, looking ahead. One, we are now kind of 2 years, 3 years into having underinvested into traditional energy, right? Because of this whole narrative, and then because of all these pressures. You can call them ESG, or transition, or other pressures, and then certainly policy has played a role in that. But also part of the challenge is that demand is the world is still powered 85% on fossil fuels, right? And demand for most of that has come back, if not exceeded, where we were pre-COVID. We're above pre-COVID levels for coal, which is the like the dirtiest, but again, like for developing markets, the most still the most critical of energy needs. We're above pre-COVID levels for gas. We're not quite there for oil, and we're like about 2% away from that. And a big part of that is basically China, and and jet fuel demand, right? From business travel and some personal travel, but also tied to China. And so we're basically back to where we were pre-COVID. We have this policy and kind of transition narrative that's tried to kind of pretend that's not the case, and say we have to sort of move towards a net zero pathway, but the world is not really doing that from a consumption standpoint, right? That is the reality. And then part of the challenge is that we want the policy directive is to kind of pivot as quickly as possible to new energy, but new energy doesn't in many cases do what old energy did, right? Especially from like providing baseload power and energy standpoint, especially in developing markets where it is still quite small. And then part of the challenge too is that I think there's been along with this net zero rhetoric, that there's been this big push that we need to spend and depending on which source you want to use, it's either 1 trillion or 5 trillion or 7 trillion a year to make this transition. And the reality is we are not going to even get to a 1 trillion. Last year we did about 700-800 billion. This year I think spending will be more like flat than actually up. We're not going to get to that, even that 1 trillion, right? So we're under investing on old energy, we're under investing on new energy. The new energy investment again is also facing this paradigm shift of higher rates, more restrictive environment, plus like supply chain issues and other logistical problems and trade problems. So really, across the energy spectrum, it's kind of a mess. And that's really, probably, I would say, problem number one, for the global economy, right? Which is that, everything kind of stems from that.
So it sounds to me like, most of these problems come from policy decisions, right? Because if it was a free market, these big energy companies call them dirty energy for this, just to make it simple, but if you're looking at companies like that, like that's a requirement of our economy. Like stuff still runs on oil and gas. So that's not going away anytime soon. But there's been such a huge push in the last, I don't know, 10 plus years to go clean energy, and we need to get electric and we need to do all these great things and save the planet. But yet at the same time, you're basically chastising the big oil companies, which things still run on that. And if they know that they're not going to get favorable treatment, then they're not going to spend on infrastructure, right? And so it seems like this has been created by policy decisions. I mean, you know better than I, but like, what is it policy decisions exclusively, or are there other things going on?
I think there's other things going on too, for sure. I mean, I think certainly investor preferences and mandates have also shifted. I would say that's all kind of part of the same ecosystem, right? The clean energy ecosystem that that especially over the last 5 years that kind of tried to turbocharge itself, which is where like things like ESG and other mandates and requirements from investors started impacting business decisions, right? Started impacting investment and capital allocation decisions from companies. And so I don't think it's, just policy. I think it's, I think investors also had, a role to play in this. I think investors also sort of miscalculated how we were going to come out of COVID, right? And then also, I think, kind of the whole ecosystem, just was so focused on the transition, over the next 10, 20, 30 years that didn't really spend enough time kind of thinking about the today and the tomorrow, and then really how the world worked pre-COVID, or even coming out of COVID. So I think that's where the disconnect has been. I think the one other issue is, is that, look, I mean, I think we had, especially over the last, kind of 7-8 years pre-COVID, this free money and open capital markets dynamic. It also helped, U.S. production, right? It also helped U.S. oil and gas production, and we kind of got used to, cheaper oil and quite cheap gas and electricity prices. And when you take that away, and when you have to move to a world where companies have to invest within the cash flow that they generate, but also provide a return to investors, so actually be like investable stocks and securities. Growth at all costs is not the priority anymore, right? So I think there are other factors that have also impacted this. But I think really, I think at the end of the day, we just kind of forgot that coming out of COVID, we were just going to end up basically where we were pre-COVID. And, except for China for now, we'll see what happens with China over the next year or two. But, but to your point, for that, you needed the same amount of oil, gas, coal, and supply and adequate inventory. And we don't have that. And then even just kind of looking back over the last 10 years, right, we've spent about 4 or 5 trillion on new energy spending across the board. By the way, that includes areas like nuclear and whatnot, which are important parts of the transition. And in that last 10 years, after having spent 4 or 5 trillion, the share of fossil fuels decreased by 1%, right? So we basically didn't really change anything. And a big part of that is because the global energy pie, total global energy consumption is still growing. And that's not going to change either. That's going to be, the case for the next 10 years. It's going to be the case for, the 10 years beyond that. And, again, we're not kind of facilitating enough supply to manage through that, because just focusing on new energy, let's just say over the next 10 years, is not going to get you there.
Yeah, to me, it's just puzzling because these big oil companies are masters at managing price swings, over time. Like they've got a lot of their production hedged, and it just seems like they're under investing in CapEx right now, because they just don't see the viability of doing these projects, whether it's through policy or opportunity or what have you. But it just seems weird that there's a big underinvestment in these companies, which oddly enough, will end up leading to higher prices, right? So
yeah, and look, like, I mean, before the shale revolution, we had higher prices, right? Because we had a tighter market, the cost curve was higher, and all of that, and we're basically sort of moving back to that era to some degree, where I mean, companies don't want to overproduce and then lead to the next down cycle, right? More importantly, investors don't want them to do that either. So that's where I think the investment community also plays, and the banks also play an important role in the conversation. But even if they were to sort of ease up on supply over the short term, especially on the oil side, right, the oil and refined product side, again, they're being told that we are trying to get oil and refined product demand to peak and decline, and we want it to go down, in 5, 10, 15 years. And so, it makes it very hard for anybody to want to, invest in anything that has some shelf life. Okay, like you can unlock some short cycle supply if it's easy and low hanging fruit, of which there's not much left anymore, but that's one thing. But to invest in like long lead life, like offshore, deep water type projects, or on the downstream side, like if anybody in the Americas or to Europe, or in Europe, to think about adding refining capacity, even if it's like not building a new refinery, but just debottlenecking or expanding capacity, why would they do it, right? Like why would they spend the money when the goal, again, from policymakers and from the transition movement, is to have demand decline over time. So that's what they're being told. But it's as you put it, it's counterintuitive to what is being pushed over the medium to long term.
Yeah. So, one thing that kind of comes to mind is, I mean, China's under lockdown and we still have really high, I mean, I would say high, I mean, they're not the highest they've been, but, high oil and gas prices. So what's going to happen when China opens up? I mean, what's that going to do to the global economy?
Yeah, that is, I would argue, like, part of the reason China has not opened up also is because of, trying to sort of avoid some of these commodity shocks, and they've been dealing with so many economic and, real estate and debt issues domestically that was like also part of the calculus. But yeah, I mean, it is definitely a problem when China, which just on the oil side could add 1 million barrels a day, of demand next year, right? Maybe not quite 1 million, but like, let's say like 700,000 800,000 barrels a day of demand next year just on its own. That becomes a kind of a big swing factor for a market that's already tight today. Even though prices have sold off, we're still like 85, 90. Market is still tight, right? We're still draining inventories, and things are still tight. So definitely China can be quite a disruptive factor should it try to come back over the course of next year. And it's not just an oil story, by the way. It's also a gas story. Basically, I would argue the main reason why Europe was able to fill up storage, going into winter, gas storage, going into this winter, by buying up a whole bunch of excess LNG on the market, was because, again, China was kind of partially locked down from an industrial manufacturing standpoint, and even from a consumption standpoint. Like if they had just been operating normally, Europe would have had a lot less gas to buy, and would have been in much worse shape going into winter. But again, next year, if China's reopening and and Nord Stream is still shut down, for the most part going into Europe, it's going to be extremely expensive and difficult for Europe to fill up storage going into next winter. So China can be a big swing factor in oil markets, in gas markets, and in other parts of the energy sphere too, for sure.
So, I mean, speaking of Europe, I mean, Europe's been kind of a mess, obviously, in the last few months. I'm curious what you think is going to happen there, as well as, kind of what's obviously with the Russia-Ukraine conflict, but also just Europe in general, since they're so dependent upon Russia for their energy.
Yeah, I mean, on the conflict, we expect that to sort of drag on in like this, stalemate. Nobody's really achieving anything, but hard to see, a short-term path to some kind of a truce or stalemate or standing down. So we just think things are going to be dragging on. And by the way, even if they don't drag on, we don't really see a whole lot of a change as far as how things impact Europe, right? It's not like gas is going to suddenly start flowing into Europe, or certainly they're not going to take it. And certainly, they're trying to do the same thing on the oil and refined product side, try to embargo as much Russian imports as possible. Much easier said than done. We think it's going to go not so well over the next couple of months, but all of this kind of puts Europe in like a pretty difficult spot, right? I mean, I think of all the weak economic spots in the world, Europe is going to be at the top of it. Certainly, in the European economy, especially Western Europe and UK too, really no different. You add them all together, they are a pretty large swath of the global economy, and we think Europe will be shrinking for early next year, maybe the first half of next year. Certainly, the deepest recession, among other regions. In the U.S., you could argue whether there'll be a recession or not. I just kind of say like the U.S. is going to be like at zero growth. It'll be like some quarters will be up, some quarters will be down. it'll be kind of more stagflationary than anything. But Europe is going to be the epicenter of economic weakness globally, and there will be some peripheral economies that feel the pinch too, from high energy prices, from strong dollar, et cetera. But Europe is going to be at the heart of it, and a weak Europe economically is one thing, but Europe will still have to keep the lights on, right? It still will have to, try to buy, oil and, and refined products for, for trucking, for, for cars, for, other industrial uses, and of course on the gas side for, keeping the lights on. And by the way, on the coal side as well. And so even in kind of a recession, they'll have to still take care of its people. And that is going to be expensive and difficult and logistically challenging. I think that's really what faces Europe. One of the reasons, again, outside of China being a little bit out of the market, for why Europe was able to fill up this year was because it kind of dialed back its industrial manufacturing sector quite a bit, right? In Western Europe, in places like Germany, and even in in the UK, there was a significant reduction in operating rates in many plants across different industries. That's going to just sort of have to continue next year, right? To balance the supply demand picture, which is weak, which is a problem economically. So that's definitely a tough tough next 6 to 12 months facing Europe for sure.
Yeah. So one thing I'm curious about is, U.S. policy around natural gas and nuclear. So if you think of like cheap energy,
Yeah.
and I guess you could argue whether gas is clean energy, but if you look at those two specifically, there doesn't seem to be a strong policy in favor of those, and yet to me it seems like fundamentally those would be the two you'd want to put all your eggs in that basket. But it seems like nobody seems to have any interest. So where does that stem from? Like, why are we not looking at either of those as good energy decisions in the U.S.?
Yeah, I mean, I think this comes back to the point I was making earlier on, like, realizing that the overall energy pie is growing globally, right? And even within North America, it's still like not done growing, and that you need to meet it with more supply of all types of energy, especially over the near term, right? To kind of get through, to be able to facilitate a transition where there's kind of a greater shift to new energy or purely green energy areas. Let's kind of disaggregate that. I mean, I think nuclear should certainly be squarely in that clean green energy bucket. I think it's being talked about that way, but converting talk to actual action and adding nuclear capacity in the U.S. is that's a very large divide, right? It's a very long bridge to cross. We haven't opened a nuclear plant here in like decades. We've been making poor decisions to actually shut down nuclear plants here, right? Like we did in New York State, we did in California with Diablo Canyon, which they're trying to reverse. So the recent history has not been very favorable of nuclear. I think the rhetoric is changing, the talk is changing. Converting that into actual action is like a whole different ballgame. That could take like years, to actually get anything mobilized. And nuclear, it should happen. I think also, to your point, I mean, I think there's kind of a very clear like anti-coal and anti-oil sentiment, right? I think gas is like kind of in this middle ground where we are still permitting and trying to expand gas LNG exports out of here to help our allies in Europe, to help meet supply gaps in other parts of the world. And gas is kind of a different story. But also I think this is again where where policy is missing something, which is understanding the role of gas in a transition, especially in in developing economies, right? Where the US, Europe, a big reason why these massive economies decarbonized over the last 5 to 10 years is because they switched away from coal to gas, right? Like US, emissions are down 15, 17% or whatever between 2005, the peak, and kind of the COVID adjusted normal where we are today. A big part of that was the growth in gas. And and you know, emerging markets should be afforded the same opportunity. But trying to skip gas, for these economies, for these regions, and have them kind of go straight from coal to solar or wind, is I think where there's still a policy gap and a debate, and where there are, where there's some rhetoric that doesn't quite make sense, right? Especially because in the U.S., like we have the resource, right? We gas supply is going to, gas demand is going to grow anyway, right? We think Asian gas demand is going to grow for the next 20 years. It doesn't really matter what people want to say or not say. And in that backdrop, we have an opportunity to grow our domestic gas business and industry, have it be one of the cleanest in the world, right? Because we are going to focus on flaring, we're going to focus on methane leaks and things like that, and actually have that be a cleanish part of the transition, right? Of a shift in the energy mix. But to your point, I mean, I think it's right. I mean, I think for both nuclear and gas, there's kind of something missing in the conversation that should be ideally addressed. I just don't know if that's going to change really in the next couple of years.
Yeah, I mean, it takes what, like 10, 20 years to build a nuclear plant, and it's like, the longer you wait, the longer it's going to take, right? So
yeah, and there are some of these like modular and other like options, right? But
yeah,
but I mean, look, like to be fair, there are parts of the world that are pushing nuclear because they understand it's green and clean, and yeah, as long as they are managing the safety aspects and whatnot, that it makes sense as part of a pathway to net zero, or whatever decarbonization pathway these countries are following. Where is nuclear capacity being added? China, they get it. The UAE, they get it. In the West, right? Like the UK and the US are kind of talking about it, but nothing's really happening. In Europe, still, like you're still retiring nuclear plants net, right? You retired one in Belgium. Germany, you extended it, but they're still planning to retire those couple of plants in April. We don't think it's going to happen, but still, like the conversation is just sort of talk, and you're not kind of pushing the right buttons to actually get anything done.
So what do you think is going to cause that tipping point? Because what ends up happening is it ends up affecting poor people the most, because everybody's got to spend the same amount, but poor people have the less discretionary income to budget that. So at what point do people just say enough? Like, what's it going to take, on energy prices for you, from what you think, for that to happen?
I think that conversation is already being had. I would say that emerging regions and producer states, right, both of which are important parts of this conversation, are already pushing back, right? Like let's just take the case of COP27 in Egypt and Sharm el Sheikh that just happened. It was this was like Africa's COP, right? It was their venue to say, cumulatively, all the emissions that have been added in the world, not all, but like the vast majority, have come from the West and from China, and Africa and other developing regions. If you want to tie the increases in carbon and whatnot in the atmosphere to greater fluctuations in weather and more volatility and whatnot, these are the regions that feel it, right? So they weren't responsible for it; they are feeling it, and so they want the West to pay up for these loss and damage issues and things like that. But at the same time, part of what they're pushing back on is this, what I was just saying on like gas, for example, right? Where they're saying in Africa, especially, Europe is coming in and telling Africa, oh, we want you to just forget about gas, go straight from coal to renewables, because that's our ideal energy transition. But then, like, you have a Russia-Ukraine situation. Europe gets all of its, not all, but like a big chunk of its gas supply get taken away, and then Europe comes asking Africa to produce more gas, right? And Northern Africa and and other parts of the Middle East to produce more gas, produce more oil, so that it can make ends meet. And the pushback is, I mean, this is sort of hypocrisy at its finest. Like, this just doesn't make any sense. And why should we listen to you? With regard to the transition anyway. So I think you're already seeing it. I think you're also seeing it, by the way, from producer states, as I mentioned earlier. where look, like you can't have a transition where you only have policymakers on one side who are trying to destroy demand, right? Be the only ones who are allowed to speak, because there are entire nations that feed its population on oil and gas production or other kind of hydrocarbon and fossil fuel production, by the way, including coal and whatnot. Like these are big industries for big countries, and you can't just kind of you know demonize them and shut them down and expect them to not speak up and have a stand. And this is where, so for example, again, back to COP, right? Like during the 2 weeks there was this push to include some text at the end of it that the UN or whoever their body is will push to phase out or phase down fossil fuels right across the board, not just coal but oil, gas too. And the producers pushed back and basically vetoed it, right? Because guess what? Like they have a say too, right? It's not just the US, it's not just a bunch of European countries that get to have the say. By the way, like the vast majority of the world's people live in China and India and Africa and other parts of Asia and the Middle East. So and they are much have much lower carbon footprints than people in Europe and the US, right? So you got to find something that allows everybody to come to the table and find common ground and meet in the middle. And that's not being done. And so back to your question, like that pushback is already there. Between now and the next COP 28, that will be in Abu Dhabi, right? Again, a producer state representing the developing world and trying to be at the intersection of a transition. Again, by the way, UAE building solar, building nuclear, building hydrogen and CCUS and all this other stuff, great, but also expanding oil capacity, expanding gas capacity, and saying this is the way it should be done, right? So I think that pushback will be, and kind of that back and forth tug of war will be happening for years. And by the way, like going back to that loss and damage thing, right? The loss and damage, a loss and damage facility was agreed to, great. Funding it, implementing it, and actually having it make a difference could take 10 years, right? Like before you even get some momentum going on that. Right now, basically the commitments to it are not even $1 billion. Like it basically is just like at the very starting point. And again, in a world with higher rates, less liquidity, central banks paring down, deleveraging, Fed's balance sheets and other balance sheets around the world deleveraging, it's difficult. There's not a lot of spare money to throw around here and there. So yeah, I mean, unfortunately, this sets up for a kind of a very messy picture from an energy standpoint, because we're not investing, we're not like ramping up investment in oil, gas, coal. We are too slow in ramping up all the other stuff, and even we're not really addressing intermittency issues with solar and wind. We're not building up storage. EVs have like all kinds of issues, including critical minerals and where they're built and things like that. So we are faced with a whole host of problems, and fixing any one of the major ones doesn't really seem like we're making a whole lot of headway over the next couple of years. So it's just going to be, I mean, I think it's just going to be a choppy energy and macroeconomic picture for years to come.
Okay, well, that's good, good insight. So as we kind of get close to time here, what are some kind of final thoughts you can leave our audience with, in terms of the energy industry and, how people should think about it?
Yeah, I mean, I think just to reiterate a couple points that we chatted about, I think remembering that, the global energy pie is growing and it's going to require, all of the above, right, to meet that, is going to be important. I think understanding, the needs and priorities of all types of different stakeholders, whether they are countries, consumers, voters, investors, companies, everybody has a voice, everybody has a say. And it's not just sort of ramming through policies or ideas, from one side, at the expense of one or more of the other sides. It's got to kind of work for everybody. And that's going to be, kind of a challenging thing. But I think the last point is that, like, really, I think what we are entering is more of like a transition into figuring out what the energy transition looks like, right? As opposed to any kind of a transition, any kind of a real transition. Like, we're still going to have emissions go up. We're still going to have coal demand go up because of, shortages of other sources. This is just the reality, right? So I think coming up with solutions that are bound to reality, that are tied to the real world, is going to have to be a part of how the transition narrative is shaped over the next, let's say, 5 to 10 years. It's not just about ambition. Ambition is great, right? But when ambition disconnects from reality, which is, I think, a fair way to put what we've seen over the last couple of years, not only is it messy, but economically it's just dangerous, and that knot needs to be untied, at least partially over the next couple of years.
Okay, great. Well, Abhi, I really appreciate you coming on the show and sharing your wisdom with us. Where can people find more about you?
Sure. I am most easily found probably on Twitter. My handle is araj_energy. So always happy to engage and talk about all kinds of different energy topics. But yeah, otherwise, my contact info is on the Energy Intelligence webpage. It's also on the Columbia University Center on Global Energy Policy webpage. So be happy to chat and continue discussions with everyone. But Kirk, thanks for having me today. Really appreciate it, and hopefully we can do one of these again soon.
Absolutely, we'll definitely have you back on the show, Abhi. So thanks again for joining us. Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview. I really appreciate him coming on the show. I have to, Abhi is a really smart guy and really appreciate him kind of sharing his wisdom. But now we're into the panel portion of the show where we have our very own Barb Friedberg. Hey, Barb.
Hello, everybody, and good morning.
Good. Well, glad to have you in the show. We also have our very own Doug Heagren. Hey, Doug.
Hey, Kirk, how you doing today? I'm looking forward to hopefully having as much fun as we just did in our outtakes. For those of you that are listening to this, we might have to put those on for some time because we're good at getting a lot of laughter and having a lot of fun with each other. And actually, there are things in the economy to laugh about. We find a snippet every now and then.
Yeah, I think we're going to start recording our pre-episode reels and our outtakes because I think they're hilarious and I think the listeners probably get them. So we'll figure out how we're going to do that, but we're going to find ways to share those because there's some funny stuff in there.
This isn't a fun topic. I mean, really, we've got to laugh it up a little and kind of zhuzh it up because we want you guys to stick around.
Well, it depends what side of the fence you're on, Barb. I thought it's fun, but many people may not. Maybe this show, this episode, as long as this topic should come with warnings. Warning: do not listen to this if you're sensitive. But we're gonna dive right in. So, Barb, what were some of your takeaways from the interview?
Well, I've been thinking about this for a really long time. I live in California, and in 2035, they are saying that they're not going to sell any more gas-powered cars. All cars sold will need to be electric. And so what goes through the discussion in my mind is, okay, what's going to happen to all the gas station owners? What about the gas consumers? And how is this going to affect my investing? And so that just keeps going around and around and around in my head. So does that mean now in 2022, 2023, should I just divest of all oil and gas because in another, 13 years, 12 years, we're not going to be buying any? I don't think it's that easy. So my thought is, what are we going to do about energy investing? And so that's what we're going to talk about today.
Great. Well, yeah, just for those of you who have not been watching our LinkedIn Live, we had one last week where we talked about, actually it came out last Wednesday as well, so the podcast listener will have heard it by now, but we talked about a lot of these questions that we're addressing today. And quite frankly, they're really important questions, as Barb says. And, some of them are serious, some of them are not, but, let's get into them. So Doug, what were some of your takeaways before we kind of dive into some of the main issues?
Well, Kirk, I think it just said, everybody just go listen to our podcast the other day. Everybody, it's been a pleasure being here. No, I think some of the takeaways that I've got, so I don't know if anybody understands the technology industry. There used to be a running joke with a company called Computer Sciences Corporation, CS. CS, I mean, I'm sure they started at one point in their existence actually developing anything of substance, but they eventually got to the point where basically I think their business model was to buy existing technology companies and then shove them on the shelf. And so the world could never see them again, so that basically they would buy out and eliminate their competition. And if you go back to kind of what we were talking about the other day in terms of the largest oil and gas companies out there, I mean, Saudi Aramco, by far and away, $2 trillion in market cap. Exxon is one we think of as a huge company, but comparatively, I mean, 257 billion in market cap puts it at only 25% of the size of the Saudis. And nobody's surprised by that. We know the Saudis control the energy trade. But it made me think of like one of the rumors around Exxon years ago is that Exxon, that's what they would do, is they would buy a lot of these technologies. I mean, a lot of these green energy technologies, like Barb was saying, should I sell out? A lot of these green energy technologies are actually owned by a lot of these oil companies because they've been investing and looking at this stuff for years. And I think that no matter where we go, we still need energy. And then you go back to, again, what I think about policy and I think about demand and economy. A lot of the oil energy out there, well, there's two sides of that. I think you addressed one that I like, Barb, is that one side of it is what happens to the economy that's supported by energy. Now, I don't think it's necessarily going to hurt the Exxons and the Chevrons of the world that are going to be able to adjust and already have looked at these shifts, and also are going to still have to produce oil to create the green energy that we want, right? I mean, batteries are made of plastic and petroleum. Your electric cars are all made of synthetics. I mean, your wind turbines are made of synthetics. They all take oil. I don't know what that's going to change there. But I also think that it goes back to something we've talked about before about GDP. GDP is one of the most misunderstood numbers on the planet, okay? It is not, people think GDP, it's everything we produce. No, it's just the end product we produce. So when you take a look at the GDP of gasoline, that's just at the pump, right? But the GDP of gasoline is all the things, all the steps that get there. So like you just talked about, Barb, if we eliminate oil, maybe the oil companies will be fine, but what about the gas station owner? That's part of your GDP, right? That's the gas that's produced. What about all of the little layers in the economy that come from that? And I think that, again, going back to policy, we've talked about this before, Kirk. It's one thing to have a great ideal. I want to protect the planet. I want to do this. I want to do that. but are you thinking through all the impact of the changes necessary to get there? And how quickly can you do it? And how many dominoes do you just, you don't not topple over, you destroy along the way? That's what it makes me think of.
Yeah, no, I think, I mean, these are really important topics. And I think, unfortunately, we have this polarized world that we all live in, that people take sides and there's no nuance. Everybody's black and white nowadays. And that's unfortunate because we don't live in black and white. We live in the gray. We all do. If you live in the black and white, you probably ought to have a tinfoil hat. I mean, it's just, I mean, the media whips us into a frenzy and puts us on sides. But, just to the point that Doug and Barb are making, I mean, there's this article we'll show you here. It's, if you look at on YouTube, on NPR, there's an article that said California's poised to phase out sales of new gas-powered cars, and this is in August 25th of this year. Next day, 6 days later, August 31st, breaking news: California Power Grid declares flex alert, urges residents not to charge electric vehicles. So, I mean, this is from the same source. It's not like right wing, left wing. This is literally from the same source. And this is California. And sorry, Barb, I got to make fun of California for a bit. But, the reality is that the problem with this clean versus dirty energy problem is people say dirty energy bad, clean energy good. Well, it's not that simple, right? We all want a cleaner planet. We all want cheap energy, right? That's the holy grail, cheap or free energy. That would allow us to do great things in the world. Unfortunately, wars are fought over energy. And, obviously that's not a good thing, right? There's a war being fought right now with Ukraine and Russia. And you could argue whether it's over energy, but I would argue that it probably is to some degree. So, you have this problem. And, Abhi was talking about the great transition, right? There's a transition, right? We can't all drive electric cars today. We can't, because there's no charging stations. There's not enough electricity for load power. They're too expensive, whatever. You can come up with all sorts of reasons. It'd be nice if we were there someday, but it's not going to happen tomorrow. And one of the problems that we're facing is that during this transition, the political powers, if you will, are trying to push the people in a certain direction to change their habits, right? Now, normally this is done by taxation, right? Giving people tax credits, like solar panels. You get tax credits for putting solar panels on your house. Great idea. You're not forcing people to put solar panels on your house. You're incentivizing to do it. So if somebody says, I don't want that on my house, great, then they don't have to. And if somebody else says, hey, I can make a profit or I can save money by putting solar panels in my house and getting a tax credit, great, they have that choice. And a lot of our tax system is based around that, whether it's R&D tax credits or, like solar panels, electric cars. The government's done a lot to incentivize behavior, which I think is really a positive thing. But when they demand you do things, you can't have a gas-powered car. Oh, and by the way, we also can't charge our cars. That's just nonsense, because the economy, if it's not a free market, it will not operate efficiently. And so what's happening now is effectively these oil companies are not reinvesting in their infrastructure, which means that at some point we're not going to have any more oil and gas powering, our economy, because the infrastructure is not being invested in. So at some point we become, basically a banana republic, and, you have to have outside countries come in and basically drill oil wells because you can't afford to, because your companies are bankrupt because they haven't reinvested in their infrastructure. So when you see things like a excessive profit tax on oil companies, it's not because they're making more money because of higher prices. It's because they're making more money because they're not incentivized to drill. They're incentivized to pay those profits to the shareholders and not reinvest into the infrastructure. And that's the biggest problem we face, because it's not going to be an impact today. It'll be 5, 10, 20 years from now. We're going to run out of these hydrocarbons. And if we're not converted by then, which is a high possibility we won't be completely converted by then, if we're not, then we're all screwed, which was the nature of the episode. We're all screwed, which is, there is a timeline we're putting on this if we don't reinvest in the infrastructure. So I do want to talk about this a little bit, because not everybody's an expert in oil and gas. I certainly am not. I know people like Abhi are, and there are plenty of people I know that are experts. But I think understanding the big trends and understanding the nuance are important. So I wanted to kind of get into that a little bit, is the practical outtakes here. So Barb, if somebody's not an expert in the energy sector, how should they look at investing? Like, what should they do at this point? Because it's a big trend, but if you don't know how to do it and you're going to do it wrong, that's just as bad as not doing it at all. So how should people look at this?
That gets back to two camps of investing. One is I'm just going to buy the market, and I'm going to stick with buying the index funds that mirror the S&P 500 or mirror the international companies excluding the US, and be done with it. And that's one way to invest. It's easy. You will get market matching returns, which frankly have not been bad. Over the past 100+ years, S&P 500 has earned roughly 9% a year on average. Obviously, that's on average, not this year. And international markets, well, they've kind of stunk the past few years, but over time they've done well. And even now they're offering a decent dividend. So for those of you out there that just want to simply manage your portfolio, that is a viable way to go. And there's a lot of research supporting it. And then there's the other camp that says, well, I want to invest to hopefully beat the market. So I want a sector pick. I want to delve into the energy industry. I think there's some value there. I like that there's dividends there. I'm not an ESG person, so that's not my lens. So if that's who you are and you think energy is a viable place to invest, and the thing is, you don't have to make a 30-year commitment. You can buy an ETF, you can buy a mutual fund, and you can buy an diversified energy sector fund. And then if you think things are not going well in the energy sector, or that sector is not outperforming, you can sell it. So that's another option. Third option, be a stock picker. But between you and me, I've been a stock picker. And if you have the time, energy, and expertise to really research and delve in, you can pick some really, you can look under the hood, read the annual reports, and pick stocks. Many people have had quite a bit of success with that. So when it gets to sum it up, when it gets to investing, yeah, you've got to be smart. You've got to understand the basics of industries if you're not a passive index fund investor. And that requires reading and studying and learning what you think will be poised to, what sectors will be poised to invest. Or it requires choosing a financial advisor who you think is smart and let them do the work for you.
That's great advice, Barb. Doug, what about you? What are some kind of practical ways that people can look at investing in energy?
Well, I think the issue with energy, and I think the issue with any sector investment, is how long the cycle can be between times in which a sector overperforms or underperforms. That's on one side. So sometimes sectors can overperform and underperform incredibly quickly. You could be looking at momentum and see that a sector is overperforming and jump into it, and then because of policy, because of world events, because of economy, because of whatever, all of a sudden it reverses and you've bought at the high and now you're stuck at the low. And I would say that, crypto has been one of those great examples, right? Of people who have invested in crypto looking at, hey, it's at 60, 70,000. Look at that momentum go. I'm going to take this to 1 million. A lot of trail of tears there. At the same time, sectors can also follow extremely long trend lines. Things like gold and oil can take years to recover. I mean, when we were investing a couple years ago, when we really finally had the economy booming several years back, we actually drove the price of oil into the basement because there was so much new oil being discovered, and we had the Balkan oil shale that was producing so much that America went from, basically not an oil producer to the biggest oil producer on the planet in a very short period of time. And well, when you start going back to the economics 101, supply and demand, there was so much supply of oil that it started to drive the price down to the point where it really drove a lot of these businesses out, these wildcatters out of business. effectively, especially when we started to have a little bit of an economic turn, we went into the COVID, boom, gone. Now they're out of the business. And now we don't have the development to come in. So now we've seen the prices go back up, but it took years for oil prices to get to a point in which there was, a sustainable or viable investment in it. So sector investing takes a lot of risk. It has a lot of risk if you're going to go directly into it. And I know Barb talked about the S&P 500 as an option. I think it's a good place to play. Warren Buffett has talked about that, but looking at the actual breakdown of the S&P 500 and wondering about diversification of it, it's about 27% information technology, 15% healthcare, 10% communication, which overlaps with information technology, consumer discretionary, 11, financials, et cetera. We start getting down into commodities, for example, utilities. We start seeing materials at about 2%, energy about 2%, industrials can include that at 7%, utilities at 3%. But the overall exposure to commodities in that may not be that big. So if you want to play into this, I think the best thing to look at, really to look at, unless you're going to do your research and really be of the knowledge of someone like Warren Buffett, who knows how to, let that tide roll out and look under the covers and really look at the details. I think you need to look at diversified commodity options, maybe funds where somebody is managing that for you. I think another way to look at it is if you understand how to use options, you can use options, puts, calls, et cetera, or use some different things like structured notes that are out there that effectively use options on the background, that banks will release these and may allow you to have some sort of a buffer or protection against the volatility in a specific sector. Because I think the key takeaway for me, Kirk, is sectors. Whenever you're getting into an individual stock or an individual sector, the volatility can be incredibly vicious and more than most people know how to manage or know how to weather emotionally.
No, I think that's really important. I think, when people invest in sectors, they tend to invest late and they tend to, hold on too long. Right. They wait until everyone's already in there and there's a big, strong trend, and then they jump in and then it turns and then they're like, what happened? I just lost a lot of money. I think it's challenging investing in sectors. I think if you do, you really have to understand what you're doing. The energy sector, for example, if you look at the future of where things are going to go, even with the government policy being negative towards hydrocarbons, you can still invest in that sector in certain areas. So, I've talked to a lot of people who are experts in the area. Like I said, I don't claim to be an expert. I know enough to be dangerous, but I have a lot of resources, people who are experts. And I've talked to them and I've complained. I said, look, there's all these challenges, but I know there's a huge trend there. And they're like, oh, that's because the whole sector it's not about the sector. There's like a subsector in there that if you look at, for instance, servicing or exploration, or if you look at all these different subsectors of energy, they might not all be great, right? Some might be downright terrible, and there might be some that are going to kill it. So if you don't understand the nuance, then this is the challenge with investing in general, right? So if you just say, well, somebody said this one company is going to do great, I should invest. Or Warren Buffett's investing in this company, so I'm going to invest like Warren Buffett. Well, you don't know what Warren Buffett's thinking, right? He might be thinking in the next 10 years, this will be great, but in the next 3 years, it's going to be terrible. Like, who knows what he's thinking, right? He's not telling you what he's thinking or why. There could be some great reasons why he's doing these things. But I think a lot of us kind of look at these experts and say, well, they're really smart, I'm going to do what they're doing. And there's nothing wrong with that. But you just, if you walk around not understanding why people are doing things, then you might be surprised. For instance, let me give you an example. Let's say, let's look back in, I think it was 97 and 98, I think it was. Warren Buffett bought a ton of silver. And when people found out, it spiked the price of silver. And come to find out after, he bought the silver and then he sold it. Like, there was a discrepancy in the price. There was some discrepancy in the market that allowed him to buy it. And then he sold it for like $2 more. I think it was trading at $5. He bought it and then it went up to $7 and he sold it. Didn't tell people he sold it. People found out later. But the point is it went up and then it went back down. But if you don't know what he's doing and why, then you could be making big mistakes because you're just following along with what's in the news. So I think that's one of the challenges here is either the news is too negative or too positive on something. And if you don't know why things are moving, then you could lose money. And I think, what we're here to do is not tell you what to invest in, but how to think about investing. And that's a lot of the mental frameworks that we're providing the listeners, is how to think about things. Because I don't know what the best energy stock is in the next 5 years, because I don't have a crystal ball, and neither does anybody else. So, you could look at things and say, this has a good probability of success, or this is an area you should be looking at, which is why we're talking about energy, because there's a huge potential for upside in the energy sector that's not being recognized. And, just like we talk about bonds, I don't think it's a good time to invest in bonds, but it's a good time to start looking at them, right? Like, when that exit point is, I don't know, but I know that I'm looking at them. And, people right now, bonds are like the redheaded stepchild, and people need to start paying attention. So I want to talk.
Kirk, can I add one thing on? Because you made me think of something. We talk about half-truths all the time, right? Be wary what you're hearing, because I like what I think Warren Buffett was a great example. There is a lot of people out there that say, well, the only thing you should ever buy is the S&P 500, because Warren Buffett says that that's what the average person would invest in. Well, it's a half-truth. And why is it a half-truth? Because he's telling you should invest. He's telling you, like he's always said, that the stock market is the best place to put your money, in his opinion, and he's done it for years. But he's also said, I don't buy stocks, I buy companies. Well, the S&P 500 is buying companies to a degree, but you don't necessarily know what you're buying in. But people have translated this as to, you should do nothing but buy the S&P 500, just buy index funds. But then let's actually listen to what's being said, and let's look at what he's doing. He doesn't do that. He's never just bought the S&P 500. He's also never bought the dip, and he's never dollar cost average. Warren Buffett waits until there is an opportunity to buy, and he keeps tons of cash out there, and he keeps that cash so that build up so that he can take advantage of opportunities. That does not reflect in any way just go out and buy the S&P 500 index fund. What he's effectively telling people, if you want to read through the truth, is I know what I'm doing and you're too stupid to do it. That's what he's saying, right? But that's been translated as by a lot of people as the only thing I should ever buy is the S&P 500 fund. So I think it's a great point, just because what Warren Buffett is doing, first of all, look at what he's really doing. But second of all, understand you're not him, and just trying to do what he's doing doesn't necessarily apply at all to your situation.
Yeah, no, I appreciate that, Doug. So Barb, I want to get into another topic here, which is when we start talking about energy, people have very strong opinions about energy. It's dirty, it's going to ruin the world, we're going to have climate change, everybody's going to die, or you have a bunch of kooks who are just, brainwashing people. Like, everyone's got their political opinion, right? So when you talk about energy, you can't not have this conversation about the philosophical opinions about energy, right? And I'm not making distinction to what's right or wrong. I'm just saying this is a reality, right? Certain topics, you do have a philosophical bent one way or the other. So how should people think about energy in comparison to their philosophical standing?
That is a wonderful question. And we've got the ESG, or the sustainable investment sector, which is environment, social, and good governance. And that is a sector of investing that focuses on companies that are predominantly doing good in the world, doing better than the majority of companies. And so we tout that type of investing as kind of investing with your values. So, for example, you can invest in a fund that has companies that have a low carbon footprint, or you can invest with your heart in that way. And so if you want to invest in that way, if you want to align what you believe, which is, climate change and good governance, or climate change is real, good governance is important, then you can definitely find, it's not going to be perfect, but you can find companies that are better meeting those objectives. So I want to talk about that. I'm not going to say it's right or it's wrong, but a lot of people, particularly a lot of younger people, feel they want to align how they invest with their values. So one thing I want to say is you're not going to sacrifice returns. There are a lot of good ESG funds, sustainable investment funds with very good returns. So that's a way to go. Then if, you may be a person that believes, climate change is real, it's bad. Certain types of energy are hurting the environment. There's a lot of data and statistics that substantiate this. I'm not getting into this because if Kirk's not an expert in that, I'm not an expert in that either. But there's a lot of data to substantiate that. But you might be the type of investor that says, okay, I get it. Yeah, there's certain technologies that are no good, but I'm just going to invest the way I want to invest because my primary goal is to make money. And it's just not a priority for me, let's say, to seek out ESG funds. So it gets down to, what is your philosophy about aligning your investing with your values, and how do you want to invest? So there's as many ways to invest as there are investors. And, if you want to go with a certain direction of, I'm going to avoid dirty energy and just go with clean energy, you can do that. There's no right or wrong way. But one thing I want to piggyback on with regard to what both Kirk and Doug were saying is timing the market. They were talking about sector investing that sometimes, a sector will just take off. Other times it's like you got to wait forever. Well, timing the market is hard. So picking sectors, doing, tweaking your market to meet what we call as environment or economic conditions. Yeah, you can do that, but you can be wrong so fast. So my advice to that type of investing is, if you want to be an active investor, don't do it with all your money, because that way you'll minimize the volatility.
Yeah, I agree. So, but Barb, what about people who have this FOMO, like energy starts to take off, people are going to make lots of money, and should people don't believe in dirty energy, should they still invest if they're going to miss out on all this potential?
I love FOMO. I mean, I don't love FOMO. I love talking about FOMO because that gets down to the behavioral finance concept of herd mentality, which is follow the herd and you're going to, ostensibly win. Well, the key is you don't want to invest via FOMO. You don't want to follow the herd, because what will happen 9 times out of 10 is you will be investing at the top, or there's so much more nuance. I cannot tell you. I travel a lot by Uber, and consequently, when I get into an Uber driver and they ask what I do, I can't tell you how many Uber drivers have said, yeah, I'm getting into day trading. I'm investing in crypto. That's how I'm going to make money. I'm just doing Uber for now. I mean, literally more times than not, I've heard that. That's FOMO. Oh, I'm tiring myself out with this. So don't go with FOMO. Yeah, it's important to be aware of the economy, of what's going on in the larger picture, of climate change, of energy policy. Yeah, that's all important. Be a good citizen. But don't change your opinion based on what's in the news or what Joe Schmo on CNBC is saying today. Do your own homework, do your own research, become more educated, and don't get all your information from Reddit.
Great. Well, I appreciate that, Barb. And Doug, I know we're getting close to wrap it up here. Philosophy versus investing. Where do you sit with this?
Well, I was just kind of to tackle on to what Barb said. Her Uber driver is the new shoe shine boy, because this goes back to the quote from Joe Kennedy with the stock market crash in 29. When the shoe shine boys have tips, the stock market is too popular for its own good. Okay, so for those of you that aren't history buffs, here's another example of history repeats itself. Okay, so what do we see when Uber drivers are starting to give tips on crypto? Might be a good time to have pause. And I think the going back to the concept of emotion, fear of missing out is what FOMO stands for those that don't know. Fear of missing out means that I don't have something that other people might get, and I might miss this opportunity. And I talked about in our last conversation, Kirk, how Charlie Munger had come out and said that the world is driven not by greed, it's driven by envy. Right. This is where wars typically happen. This is where most things happen. It's not about I want more. It's about what do you have that I don't have? And this goes back to the philosophy of sports. If you're training for sports and you train in a vacuum, you will not be as effective as when you train against other people. You have to have a benchmark. Runners that run by themselves don't run as fast as a runner that trains with somebody else. It pushes you further because now you have something to work against. And FOMO is kind of that philosophy that Charlie came up with is the same thing. We wouldn't have greed. We wouldn't have a demand or a desire to have more if we didn't know that what we had was not as much as we could have, right? So when you go into the FOMO philosophy and really making decisions based on envy, it's not just about what you don't have and what you can have. It's also just a general sign of your emotional competency. And EQ is critical because if you're emotionally driven by the fact of what you don't have compared to others, emotions don't go one direction. They're not unidirectional. They're dual directional. The chances are that you're going to have the same emotional competency, which is limited in this regard, when all of a sudden what you have starts to decline because it'll exacerbate your fears. Your fear is that you know where you are today and those that have more are doing better than you. Well, you knew what you had today. When what you had today now becomes less than what it had, then that same emotional I don't have enough just gets compounded. So the philosophical side of this is if you're that emotional, if you ever face the fear of missing out, if you're ever jumping in to doing something, not because you fundamentally believe that it is an opportunity that is going to be good for you. Like I said, Warren Buffett doesn't buy stocks. He buys companies because he thinks they're good companies. He doesn't really care what they're going to do in the short term. He thinks about what they're going to become in the long run, that he can sit on this company. And yeah, he knows when to get out eventually, but basically he's looking at what ran that company well. What kind of profit can that company make? Who's the leadership? What decisions have they made? What kind of market share? And he's going to sit on the Geicos of the world, and he's just going to continue to collect their growth and value and income indefinitely. He's not emotional about it. He's objective. That's why, again, when there was all this, run up in the market a couple of years ago, people were saying, well, why would you ever have cash? You should have in the market. And he's like, look, I'm sitting on $1 billion of cash because I don't have a place to put it. And personally, I want to have options tomorrow. That's logical. That's his philosophy. And does it always work? No, but he sticks to it. So I guess the thing that I look at is really have self-awareness, which is one of the greatest missing aspects most humans have. Go out on social media and you'll find very quickly that the majority of people have no self-awareness. They're quick to call out you, but honestly, they're not, if they looked at the mirror, they'd realize all of their own flaws. And if you have the fear of missing out and you're absolutely going to make decisions based on that, you probably need to turn over all of your financial decision making to someone else because you're incapable of being able to manage the volatility when it comes. And as I've said before, Kirk, we wear a seatbelt when we're in our car, not because we're in a crash. We wear the seatbelt when we're in a car so that if the crash ever happens, it keeps us from going through the windshield. Does no good to try to put the seatbelt on while you're halfway through the windshield. Okay, so if you have logical approach to doing this, there's some great opportunities to be able to invest, great opportunities to diversify and build wealth yourself for a long-term perspective. But if you are thinking on a short-term perspective or you're letting emotion dictate any decision that you have, then that is the reason why you want to look at outsourcing those decisions to somebody else who, again, if you ask the right question, even advisors have emotions. They've seen it. Make sure that they are someone who has a philosophy, that has a process, that is using a logical approach to the decision-making, because there's no such thing as good advice or bad advice as long as there is a process and a philosophy of that advice.
Yeah, that's great insight. So as we wrap it up here in the interest of time, Barb, final thoughts from you on this topic.
This was a lot.
Barb's burnt out. She's done.
Yeah, we really covered the gamut here. And I'm really going to hate myself for saying this again, because it's like I say this every freaking episode. But if you want to be an individual investor and you don't want to do the passive index fund investing route, or you don't want to hire a financial advisor, you've got to get information about investing. You have to learn, you have to study, and you have to go to reliable resources. Now, where are those reliable resources? Well, Investopedia, whom I happen to write for, and Forbes Advisor, and your broker. So Vanguard, Schwab, Fidelity, E-Trade, they all have really sound educational information that can help you become a smarter investor. So you can find me, Barbara Friedberg, at RoboAdvisor Pros, YouTube, or Barbara Friedberg Personal Finance. Bye for now.
Great. Thanks for coming on, Barb. And Doug, final thoughts from you.
Well, again, like I said, I think of taking the emotion out of it. However, that has to be, if you're generally a logical person, and you are someone that has and can build a philosophy and stick to that philosophy. I'm not saying stick with your investment forever. There are times to be in an investment, and there's times to be out of it. But if you have a philosophy and a process for how you make those investment decisions, well, logically, my light just did a spin. Weird. Then I think you may have the capability of potentially doing this. If not, look at outsourcing. Again, we worry about costs, we worry about paying other people, but listen, I pay someone to paint my house because I don't want to be sitting there for weeks on end on top of scaffolding, painting my house at 25 feet in the air. I want to have it done, right? And I'm not great at it. I drip, I get paint on the carpet, I get paint on the blinds. But I've hired a painter that also put paint on my carpet and paint on my blinds. They did not have a philosophy. They did not have a strategy that was out doing what, at the level that I was paying for. So make sure that you're finding someone who's logical, that has a process. And if you believe in that process, stick with that process. It's a long-term marathon. It's not a short-term sprint. And in the long run, a good philosophy and process always works out. Find more information about me. I've got 2 places to look. You can go to procollegeplanners.com. Speaking of games, speaking of something that's too expensive that you need help on, and that is college planning. If you have a child in your household that's between freshman year and senior year, you need to get started today. The time is now on figuring out how you can not only get the cost of college down, but pay for college. There are many creative ways to pay for college that will allow you to have more money for your future. And the second is through automaticbusinessmethod.com, the ultimate method to get your business to work without you. So if you're a business owner and you're thinking about work-life balance and you're thinking about value of your business, there's a systematic bulletproof process, which is, as we've been talking about, to skyrocket revenue, get ideal customers, create more free time, have the perfect team without spending high cost of marketing or complex technology. Listen, the economy is getting tougher. Make sure your business is efficient right now. And when the hard times come, you'll be prepared for it.
Great. Well, thanks again for coming on, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.